Alright everyone, welcome back to the channel, and today we are going to look over trading options using the supply and demand strategy. So first off, welcome, and if you find anything helpful or informative in this video, please like and subscribe. I'd greatly appreciate it. About 75% of people that are watching the video are not subscribed, so please subscribe so you can get all the latest videos that I send out looking over Thinkorswim or any supply and demand strategies. I would greatly appreciate it. So let's jump into the video, and we're going to go over the basics of the supply and demand, as well as look at some actual examples, as well as charting some actual stocks and how you would go about doing that. So first off, we're going to look at what is supply and demand. So just like in any economic thinking, if there's an excess supply, more supply than there is demand, you're going to have an imbalance. So when there's an imbalance in the market, largely from institutional buyers, that can cause the price to move up or down. That's what causes fluctuation in price, not typically retail traders that are buying 1 to 100 shares. It's your institutional buyers like ARK Invest or any other big hedge funds that are buying millions of shares, hundreds of thousands of shares. If they're buying shares, they're the ones that are moving the market. So for an example, if an institution wants to buy 500,000 shares at $100 a piece, and every time there's a set buyer, there has to be someone that's going to willing to sell at that price. So they may not be able to get all of their contracts or all of their option stocks filled at a specific price. So they were only able to get 400,000 sold or filled at $100, and now the price is $102, $103, $104. With that large volume coming in, it caused the price to move up. Then they have their remaining 100,000 shares out there that didn't get filled for the price that they want, and they're not going to chase it. They're going to wait for the market to come back down and hit that $100, and then they'll buy their additional 100,000 shares. So that's what we're looking for of when we get a spike or a drop, a big movement. That is what you want to look for to when price returns to that area. Those unfilled orders are going to be sitting there to get executed and triggered to cause the price to hopefully move back in that same direction that it did previously when that happened. So these can be plotted on a chart that provide low risk, high reward trades. You plot on time from weekly, 4 hour, 3 hour, 2 hour, 1 hour, 45 minute, 30 minute, even down to about 15 minute. That's probably as low as you'd want to go. And then you can even use this in like intraday trading, looking at probably the 5 to 10 to 15 minute time frame. You can look for balance areas within a pop, looking for that to come back and hit that again to have a pop again from that level. So if we want to look at what demand is, so you look at the left of the chart from your current price, and you're looking for a red basing candle. So you want a red candle followed by a big spike in a green candle, and you want this candle to be a small bodied candle. You don't want it to be this big red candle, all the body, there's no wick, or you want it to be a basing candle with ended up being a balanced area where buyers and sellers agreed in a small range on price. And then the next candle, we have a pop up. So you draw your zone from the top of the body to the bottom of the wick of that candle. So that's going to be all your area where there was buyers that were interested in this. You don't have it up here because, as you saw, the price got up here and then it came back down. And this is a red candle. So we opened here and then price fell, and then we closed back up here. So it fell all the way down here. Buyers drove us all the way back up to this point right here. And then we went over this candle, and there wasn't really much of any drop, and then it just rallied from there. So from this candle here, you have this whole demand zone. So you look for price to come back and test this zone, which you can see right here. That's 2, 4, 6, 8 hours later. So it looks like the next day on Friday, that opening 2-hour candle, we came down. We just barely touched that 238 level. And then we popped and rallied for the rest of the day, ending at 240, up to as high as 244, and closed at 241. So if you were looking at this, you could have gotten in long here once we breached this 238 and rode this up. You could, if you are falling fully, you can put your stop at the low, would be typically the low of this candle or this demand zone. So if we break this 235-ish, then that would be your stop loss. Or you could take it lower. So if you took it right when we hit 238, and you could have had it for the low of the day or some other low or somewhere that you saw some other support or resistance. You can take your stop anywhere within this zone if you feel comfortable. Typically, if you have it sometime in a smaller time frame, say this rallied down, it fell all the way down to 237, and then we started to rally up, and then you saw that we had buyers stepping in, and you felt comfortable taking this long, that we were going to get a move up, then you could have taken it long at whatever 237, and then had your stop below the low of the day. So you could have even a more minimal risk if you have it not happen instantly. Like if it happened, you drop down into the zone, and then you take your position. Say when we exited at 238, that's when you took your long contract out of 238. You could leave your stop at the low of the day. So if we got down to 237, then that could be your stop. So you can have different stops however you feel comfortable. Typically, you would have here at the low of the demand zone, but this is it's only $1.50 zone, so it's not that much on a $238 stock. So you could leave it here as your risk, or it could be some other area in this zone if you want to take it for your stop. So looking at supply now, you're looking to the left of the chart for when price dropped, and you're looking for a small green basing candle. So you see this small candle here. We have a small candle. There is a large wick, but you can see this buyers and sellers ended up agreeing around here. And then the next candle, we had this large drop. So you draw your candle from the opening of the candle, the green candle, to the top of the wick. So all this zone, we had sellers that were driving the price down. So the price got up here, and then sellers drove it back down here, and then we closed. And then this next 1-hour candle, we dropped hard and dropped for several days, it looked like. So then you're going to look for price to rally back into this zone. So a few days later, we peaked up here, and then you could have taken this short and rode this down once we hit this supply zone in the future. So you're always just looking for the price to come back into that zone, waiting for confirmation to see that it's going to hit, and you're going to get a movement out of that zone, and then you can take it short or take it long. So you could put your stop, like I said, at the top of this candle. You could look and put it at the top of this candle, previous candle that we had our drop in. So whatever you feel comfortable in doing your stop, depending on when it hits, you can look. If you took it long after we got below 763, you could have had your stop below this low of the day candle. So you can adjust it any way that you like for that to be. So those are looking at what we're looking for. So we're looking for demand. We're looking for a small red basing candle followed by a big move, a green. And for supply, you're looking for a green basing candle followed by a red drop. That's going to be your supply zone. So that's what we're looking to plot off of. So now we will go and look at this in Thinkorswim and go over some examples. So here is an example looking at Roku. So looking at this is a 3-hour time frame. So we can look at this from what is this, Thursday? So Thursday's opening candle, we had this red basing candle. So price rallied to an all-time high, and we came back down, and then buyers and sellers ended up agreeing here, and then we had this rally the next 3 hours for the rest of the day from this zone. So this created us a demand zone, a 3-hour demand zone. It wasn't the strongest zone because we rallied from 221 to 224. So it was only a $3 move. But as you can see, on Friday, we came down, tested this zone, and then bounced from that zone. So if we look at a smaller time frame, we can look on Friday. So we were in this zone for those 3 hours, just hovering in this zone on Thursday. And then one other thing, whenever you're doing your charting, you want to make sure extended hours are turned off for any stocks that you're looking at. If you're looking at your futures, either the ES or the NQ, you want to leave those on because those are trading pretty much 24 hours a day. So those you want to be able to get your supply and demand zones during the overnight session to help you during the trading session. So that is one call out. So you want to make sure that you have extended hours turned off while you are charting for that. And then when you are actually trading, you can have your extended hours turned on to see what is going on pre-market. But you can see here on Friday, so this was Friday open. So we opened above this demand zone. We stayed above it, then we dropped, and then we had these, 5, 10, 15, 20, 25, like 30 minutes that we were sitting, just kept tapping this demand zone. So you could have taken it long at any one of these points. And for this example, you could have kept it at the low of the day. So if you took your long here, probably here, you could have done it. If you did here and had your low of the day, then you would have been risking, 221.89-ish to 221.70. So you only had like a 20 cent risk. You could have put it longer. So say you wanted to risk it if we got below 221. So you could have a 90-cent risk. So if you hit down here, then you would sell. But you can see we just kept basing in this zone here. And then we finally had a rally from this 221 to 225-ish. So you could have taken it long. If you did get the perfect entry here at 221.90, you could have rallied this all the way up to 225 for the rest of the day. Or if you bought a quick scalp on Friday for a 0-day expiration, you could have probably had a good 100% if you took the 222.50 calls, and this we rallied to 225. So you probably could have gotten a big jump just off this demand zone bounce here and then us rally. So for another example, we'll look at Boeing. So if we look at, I believe, this was the big news. So there's a lot of demand or supply zones up here that we've hit, and each time we've hit, we've dropped from these. They have stacked demand zones, daily, 3 hour, 1 hour. So there's all these zones, but this big wick we got here on Wednesday, looks like, or Tuesday. And then we had this big drop. I believe that was contributing to the news on stimulus and Donald Trump and all that, and the airline bailout. So that was this big drop that we had here, and then we bounced perfectly at this 15-minute supplies or demand zone. So if you had that charted as people were buying puts on that, you could have known that there was a demand zone down there and not gotten caught in that. And if we zoom out, we can see that zone. So if we look here, right here, you see this basing. This was after this gap up. We rallied, then based here, and then we had this rally up after that. So now you want to look for the price to come back to that zone at a future date. It doesn't matter how long ago it was. It could be 2 days, it could be 1 day, it could be 3 months. Then here we fell, and then right at the end of the day, we dropped into the zone. So it probably wouldn't have been something you would have taken just because holding overnight when we just tapped the end of this supplies or demand zone, it could have easily failed and we could have fallen through and that would have invalidated it. So anytime you break a zone, you will delete your zone because it's no longer a demand zone now that all the orders got filled in this zone. So this zone is still valid because we haven't broken it, but typically you would mark it as a used zone just so you know it's likely not going to hold in the future as you come to that zone. So then we rallied from there. Then we also have a 2-hour demand zone. We look at that here. So on Wednesday the 7th, we created this 2-hour demand zone right here. So we have this small basing candle followed by a rally up. And then we came back and tested it here on Thursday. Came and hit that zone and then rallied to 269. So you could have had a rally from 264, swung it, and had a rally to opening on Friday to 269. So you have that zone. And then we also had a 1-hour zone form here at 265. So that zone is our next demand zone that we're looking for. So we're looking for price to come back, test this 165 zone, and then we look to take it long, bounce from that zone. If the price, we don't ever get confirmation and it rally from here, it could then fall. We have a key level here at 165 that could hold, but we could fall back to this 163 zone and then could get a rally from there. If we did break this, then this would be an invalid zone, and we would not look to use that going forward. So those are just two examples. We will look at a stock that someone recommended, and we will actually chart it to go over that. So this is AVGO, Broadcom. So typically I start at the weekly zone and then work my way down, looking for something around the price that we're at. You don't need to necessarily look for something over here, because if you look for, okay, this would be a supply zone, but we've already broken through that before, so that would be an invalid zone. This you could have as a valid demand zone, but that's at 305. We're at 380. You could put it on there, but we're likely not to get there anytime soon when we're up at 380. So we could put one here. So we have this basing candle followed by this rally. So we could put a zone there. So you want to put it looking at our opening price of the candle was 261.68. So that is what we want to put as our price. So I have mine set to green. So you want your left extension off, your right extension on to show the name on the right, and the price on the right. So I said that was $361.68, I believe. I have mine green for the demand zone, and they'll be red for supply. So then we will call this weekly. So now we have this weekly demand zone, and now we need to draw our rectangle. So I have them set up here in my toolbar. You can also get them down here at your drawing tools. So there's your rectangle, there's your price level. So you can get those down there. Or if you right click on your chart, you can go to add a drawing, and then you can get your drawing tools from there as well. But we want to get our drawing, so you want to draw from the top of the body to the bottom of the wick, which there really isn't a wick on this one. But we'll just draw that. So now we have our demand zone. So I don't do anything with this. Just change your color. So I use the green color, and then go to more, and you have the HSV to a transparency of 75, so it doesn't shine too bright, and you can see, and then you can save it as your default, and then it'll always be set that, so you don't have to change it. And then I just have to change the red color whenever I have a supply zone. So we have this weekly zone. That's the only one that's really applicable that we can see easily from there. Then if we go to daily and get back, so you want to look around price. So you have this, but that's not a basing. Here you could have a, would be looking for a drop up, so there's nothing really there. Here you could have a, you have a small base followed by a rally, so we can call this a daily demand right here. So it'll be the top of the body to the bottom of the wick. So we will draw that, and then we can extend our days out. And then we want to put our price level, so we want it to be at the open. So that's at 268.35. And this is daily. All right, then go to our 4 hour. So we have this here. You could put another zone down here for a 4 hour, just if you want just a price level. Just for another zone, if we did break this daily, then you could see, okay, well, we have this 4 hour here as another potential zone. So it's up to you if you want to put that, but we'll just put this here just to show all the zones. So that opened at 366.96. So we'll put that. So I got that right, and then we'll call this 4 hour. We're trading at our all-time high, so we want to find something on around here for a small green and then a big drop. We don't currently have a good basing candle here yet on the 4 hour, so we will keep going and looking. So 3 hour, you have a base here, but you want to see a rally from that, and here we have a basing candle, but we want to be a red basing candle, not a green basing candle. So we don't have anything there. So now if we go to the 2 hour, nothing there, which we're still at all-time highs, so we're not looking for anything more to the left. We're pretty much just only looking around for our supply zone off this top of 380 that we then fell to 375. So now if we go to the 1 hour, so now here on the 1 hour, you can see here, so we have this small basing candle followed by a big drop. So we can calculate this as a supply zone. So we want our open at 378.29. So then this is 1 hour, and we want this to be red, or this pinkish color. So now we have that 1 hour zone. Now we need to draw our box. So our box is going to be from the start of the body to the top of the wick. So that's going to be up to our all-time high at 380. And now we draw this over. Then right-click, edit our properties. And now we want to make this the pinkish color. Now we go to our more, our HSV, change that to 75. And bump our dates out. And there we go. Zoom back out. So we kind of have a base here, but we don't really have a good rally off that point there. So let's try and see if we got anything on our 30-minute. I mean, nothing really too much. So that would probably be what I have. You kind of have something here. But you could call this a light 30-minute supply or demand. So typically you would go to the bottom of a wick on this one, but typically I do, if we have the next candle, our rally candle had a wick on it, usually I go to the bottom of that wick, or same for supply. If this was a green candle and then our next red candle rallied up to up here and then we dropped, I would put my supply zone up at the top of there. So you could realistically call this a 30-minute demand, but it would not be super strong at all, and one that I would be hesitant to take. But you could have this here at a 30-minute demand zone. So ideally, you would look, remove that. So ideally, if you're looking to trade this, you would look for either price to fall back to 368, or us rally into 378.29. And then if we do hit that, look for confirmation that it's going to sell off. If not, we could get volume building or any other indications of it pushing through supply. And then if we do break 380, then this zone would become invalidated and be deleted. And then wherever we had our rally from down here could then potentially be a new demand zone for the future. So with these zones, you can look to, like I said, take your option or your long or short based on where you hit, and you can set your stop within that zone or somewhere else within the zone if you feel less comfortable depending on your risk management. So that will do it for this video. If anyone has any questions or anything, please leave them below and I will get back to you. Hope you enjoyed. Thank you.